Okay. Now in life, do we really want to break even? As I said, is breaking even going to get you friends, dates, and fun weekends? I don't think so. So let's do the same example, but now I want to make a profit of 20,000 bucks. So if I want to make a profit of $20,000, then working through the formula, sales price, that's sales price times X, total revenue equals total cost. Or total revenue equals, total cost. So that's break even. But now total revenue equals total cost plus profit. So this plus profit. Or in the numerator top, I'm going to add plus profit or minus loss. Why do I say minus loss? Because they have asked questions, how much do you have to sell to only lose $20,000? So it's plus profit or minus loss in the numerator. Back this way, same thing, fixed plus profit or minus loss. Okay, that's in the top in the numerator. So let's go back to my example. I've got 60 plus 20. Now that's 80 over 8. Now instead of 7,500, I got to sell 10,000 units. Interesting. So 10,000 units, that would be 10,000 at 20 bucks. That would give me 200,000. 10,000 is 120, gives me 80. Fixed costs of 60 gives me a profit of 20. There we go. So it works. Using this formula, what do I end up with? I end up with 60 plus 20 over 40%, which is again 8 over 20, is going to give me 40% of something is 80. How about 40% of 200? 4 times 2 is 80 equals 80. Boom, there's 200. There it goes. So remember that that's your formula. In the numerator, plus profit or minus loss. That's called break even in units. That's called break even in sales dollars. So that's an important concept. Let's look at cost, volume, profit and read it. Cost, volume, profit, CVP analysis provides management with profitability estimates at all levels of production in the relevant range. So again, relevant range. In making decisions about new products or services, companies often rely on cost, volume, profit analysis. Generally, we're looking at a couple of applications, determining sales to break even, a profit, or sales to achieve return on sales as well. There's your formula, break even in units, boom, break even in dollars. And then I gave you an example, kind of like what we just went through. And you can see how it kind of works pretty straightforward. It talks about desired profit. Again, if you want to make a profit, how to add that in as well. There's also something called margin of safety. Margin of safety is your total sales minus break-even sales equals margin of safety. So you've got total sales minus break-even. The extra is your cushion or your margin of safety. So that is, again, the excess of sales volume over break-even point. That is your cushion or your margin of safety. All right, so that's what we're dealing with when we talk about break-even analysis. So you've got to remember the formulas. Again, break-even is what? Fixed costs over contribution margin per unit. If you want a profit, fixed plus profit over contribution. If you want a loss, not that we want one, but fixed minus loss over contribution margin. Same thing with break-even in dollars. That's going to be dollars over non-dollars. What's non-dollars? A CM ratio. Remember, the top is called the what? Numerator, and the down is the denominator. All right, let's try some questions on this.